Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 197th VideoCast, 187th podcast for the week ending July 27th, 2023. We'll get you caught up on some kid activities, and then we'll get right down to it. This was Mimi practicing for the Junior Olympics. She just went out to Texas for the next 3 days with Caitlin. And I'm here with Annabelle because Annabelle just got back from Los Angeles Junior Olympics for water polo. So it's been busy. And last weekend, as you know, Mimi had the age group champions in Connecticut. And at Wesleyan, she got CT top 16 in Connecticut, which is a prestigious group of the top 16 people in each stroke. She just turned 11. So for 12 and under, which is pretty amazing, for 400-meter free, 200-meter fly, 200-meter freestyle, and a double-A cut in 200 fly and 400 free. So strongly exceeded expectations. And as always, tradition when we travel to new places, we like to hit at least one of Guy Fieri's diners, drive-ins, and dives. This place, Guida's, I think in Middletown, was not featured yet on Guy Fieri's show, and it should. Voted best hot dogs in Connecticut. It was awesome. I'm a simple guy. 12-inch, cut down the middle, snappy soubrettes. You can't go wrong. Buttered rolls. I mean, it was just amazing. I mean, the simple things in life, right? So there, it gives you an idea. Then we took her to see Choate Rosemary Hall, the prep school. And sure enough, for those of you who've been following for a while, you know the story of the snapping turtle in our front yard, and all of my Asian friends saying that's good luck for Alibaba. Well, of course, we just randomly ran into another snapping turtle. So good things to come for my superstitious Asian friends with the good luck of the turtle. We'll take it any way we can get it. And there you go. So that's Annabelle out in LA, Hollywood, I guess Disneyland in Anaheim, Hollywood, her first time out there, and that's Mimi on the way to Texas. So it's been a busy couple of weeks, and I want to thank David Lynn of the David Lynn Report. Those of you probably remember David Lynn used to do the shows for Kitco, which is the largest metals dealer, and now he's got his own channel, which is fantastic. You should check it out. And we're going to go through this because he recorded this with me right after the Fed meeting yesterday. And I laid out the full playbook for the second half, the implications of the Fed meeting, what we're looking for. And in short segment, it lays out everything that I would repeat in the VideoCast podcast on the first half. So we're going to listen to this real quickly. So while everyone's cramming into the S&P 500 right now, they're going to, at best, get 5-8% before the end of the year, whereas in the small caps, and it's already started to move a lot, but they could probably double or triple that. And be in a very good position by skating to where the puck's going versus where it's already been, looking through the rearview mirror.
How should investors be positioned in light of the recent FOMC decision to hike by 25 basis points? We're here to discuss this with hedge fund manager Thomas Hayes. He is a managing member of Great Hill Capital. You can also follow his writings at Hedge Fund Tips on Twitter and hedgefundtips.com. A great thread. You should check it out. Thank you very much for joining us today. Thomas, good to see you.
Thanks for having me, David. Great to be back.
Before we talk about your outlook, I just want to ask you, I'm curious, did you make any outsized bids and trades before the FOMC decision today in anticipation of any surprises?
No, we stayed long and strong. And as you know, we were one of the few handful of bullish strategists since last fall when everyone was saying we were going to go down another 20% after we were already down 25, 27%. We were saying pound the table, buy. At that point, what there was to buy was semiconductors and tech, which were the most hated. They led the first 5 months of this year. They've been a monster trade. And now as we move into the back half, there's a new group that's going to lead the back half of the year. And I'm sure we'll talk about that in a few minutes.
Yeah, excellent. The dollar's down slightly today. Risk assets, the Nasdaq's flat, the S&P 500 is flat, slightly down. Markets aren't moving much, so not a lot of surprises. Were you surprised by anything that Fed Chair Powell said today?
No, you had to expect, we came in hot into this meeting. I think a lot of the bears were hopeful that Powell would give them an opportunity to buy stocks because they've missed a 30% move off the lows. But he really didn't do anything other than what was expected, which was give the rate hike, say we're going to remain data dependent. Every meeting is live until it's not. We've got 4 more bits of major information, 2 employment reports, 2 major inflation reports. And what he's effectively saying for those people who study the data is that the inflation numbers, due to continued base effects and owner's equivalent rent, are going to be weak, just like we saw this month. And that should give them enough cover. The thing that's interesting is they did actually have ample cover to skip this month if they wanted to do. He's got in his mind that he's afraid of being Arthur Burns from the 1970s, but the conditions today relative to the 1970s are nothing alike. And I think that's honestly the big risk moving forward, is that he miscalculates, he overplays his hand, and he snatches defeat from the jaws of victory. However, that's the bad news. The good news is you got Bullard coming off, going into academia. He's a major hawk. And you got Goolsbee starting to have a bigger voice, who is a dove. And I think that the data is going to be supportive enough, as it was this month, to skip this month. But certainly by September, they'll not just have 1 3 handle on headline, but they'll have 2 or 3. And maybe a possible 2 handle, which will give them cover. I mean, they just wouldn't be justified to continue with another hike if we came in even with headline. They could turn to core, but in the 2s, it would be ridiculous to risk putting a lot of people out of work just for his ego not to be the next Arthur Burns.
Somebody did ask him at the meeting whether or not his policy was restrictive enough. He kept alluding to the fact that the economy is strong, jobs market is resilient. Well, if everything's going great, Thomas, wouldn't it, this is the question posed to Jerome Powell, if everything's going great, wouldn't it logically make sense that inflation might have the risk of ticking back up if policy were not even more restrictive?
Well, there's 2 things that he can do. One is to stop and move backward. The other is to stop and keep things elevated. And I think you've got quantitative tightening happening in the background with the reduction of the balance sheet that many people forget about because they're not actively talking about that as much. But number 2, and the thing that he could do, which would enable him to have a monster victory, is stop hiking in September, but keep rates elevated for a long time. And if he does it right and he doesn't get too aggressive, he could have a situation like 95 to 2000 where the Fed funds rate was just about 6% for 4 or 5 years, and they kept it elevated and growth continued for another 4 or 5 years. So that's how they have to play it. But if they choke it off too soon, that's problematic. I think with the next 4 major data points, though, they'll have no justification to hike again. They'll continue to talk hawkish, and they'll continue to skip all the way to the bank.
So let's talk forward guidance then. The CME Fed Watch tool as we speak right now, as of market close on Wednesday, it's anticipating a 77% chance of no hike by September, and even an overwhelming probability of no hike by December. Do you share that consensus?
I do. I think he's done. I think that the data will in no way give him any justification to do another hike by September. And on that basis, he can continue to talk hawkish in order to maintain long-term inflation expectations, so that people's behavior does not change in the short term, which would cause a reacceleration. So the data will give him cover. He won't have to hike in September, but he should continue to talk hawkish to keep those 5-year inflation expectations pinned in the 2s, the low 2s, where is their target. And the other thing they have to keep in mind, the debt service has become increasingly larger due to the hikes. And on that basis, he really can't afford to hike much more. So he's got kind of balanced two different things, $1 trillion of interest expense and a little bit above trend inflation. If you look back to post-World War II, the way we got out of 120% debt to GDP was letting inflation run hot and inflating our way out of it. Inflation ran 3 to 5% for 4 or 5 years following 1948. And debt to GDP collapsed from 120% to 63%. And I think that's the playbook they need to follow moving forward.
Okay, so given your outlook on the Fed funds rate, what's your outlook for the short term and long term of the yield curve?
Well, I think the biggest surprise for the second half of this year, and where all of my focus is on, is that there is going to be an unexpected rally in the 10-year bond. If you look at the commitments of traders, which is an important measure that we look at very carefully, it works differently for different instruments. But when it comes to 10-year bonds, you can look and see that the commercials have been aggressively getting long for the last couple of months. They always are early and they always are right. I think in the back half of the year, what no one's expecting is that the 10-year is going to get bid, and that's going to have a huge impact on this rotation moving forward. The two key themes for the second half of this year, in our view, are US dollar continues to be soft and weaken. And number two is the 10-year bond gets bid, which compresses yields, which has a positive impact in terms of mortgages, in terms of banks, in terms of REITs, and in terms of the rotation into small caps, which the largest sector, of course, 21%, is financials and small banks.
If bonds get bid, are the markets then assuming or forecasting softness and economic growth? Or the other way around?
I think two things. I think the other way around in part, but number two, keep in mind that the problem with the regional banks in March was in part a mark to market because they had longer duration. In the case of SBD, it was 5.7 year. In some of the other banks, it's longer. So as the 10-year gets bid, they're going to have mark to market improvements. Same with their loans are going to get bid, and that's going to enable them to put more capital to work and re-accelerate lending because they no longer have capital constraints as their portfolios and as their balance sheets look a lot better as the 10-year yield gets bid. So I think that's something to keep a close eye on because if there's been a few areas that few people have been paying attention to up until the most recent 5 or 6 weeks, small caps, regional banks, REITs. Okay, we've had a pretty big trade on that since the mini financial crisis in Vornado, which was the most hated sector of the market in March or April. Commercial real estate, everyone said it was the end of the world. We said properties in New York City, it's never the end of the world. We're very interested. These are trading at a 40% discount to book. And now those are up 40, 50% in the last few months. That was the most hated trade. Now it's just getting started, by the way. So there's a lot to do in REITs. There's a lot to do in small caps and bank rotation. And then if you look at dollar week, what are you seeing today? You're seeing the exact antithesis of the first half. Banks are up, small caps are up, and China is up. Emerging markets are up. And what's down? Dollar's down. 10-year yield is down, tech is down, and semiconductors are down. And I think that persists. Now, this rotation, David, it doesn't mean tech is going to crash and NVIDIA is going to crash and Microsoft's going to crash, although Microsoft's down 4.5% today. It means that they so dramatically outperformed in the first half of the year, it's possible we could see them underperform in the second half of the year. It doesn't mean they have to crash. Doesn't even mean they have to pull back. You could just see everything else start to work really well, like the groups we're talking about, and they perform less well. Now, because of their weighting in the index, that means the indices are going to perform less well, even though there will be plenty of stocks and opportunities under the surface that could be up 30, 50, 70% in the second half, while maybe the indices are only up 5 to 8% after being up 18% in the first half, year to date kind of situation. So in the context of the interest rates getting the 10-year getting bid, we talked about what to do there. In the context of weak dollar, the opportunities are in multinationals that get more than 50% of their revenues from abroad. Very few people have the dollar weakness baked into their second half estimates. You have emerging markets in China will be an incredible opportunity. We're already seeing a bid there with the Politburo meeting and signaling massive stimulus in the second half. And then finally, with risk on, I think biotech is going to be a place that's been kind of doing nothing for 12 months. It's modestly up off of its last May lows, but there's going to be great opportunity there as well.
When you use the word underperformance, are you referring to underperformance relative to the first quarter or underperformance relative to other assets and sectors?
Both. I think both. So I would look at it in context of certainly underperformance relative to the monster first half of the year. Certainly underperformance relative to the sectors that money is starting to rotate into as the rally broadens. And general underperformance, there will be some of these long duration mega cap techs that could be flat for the end of the year. And I'm not saying all of them, and I wouldn't make that bet, and I certainly wouldn't be shorting any of them. but I wouldn't be adding new money to kind of the Magnificent Seven at these levels. I'd be probably holding some of what I have, maybe trimming in some cases, but making sure I have a lot of exposure to where the puck is going.
I keep hearing that tech is one of the sectors that are most sensitive to interest rates, especially higher rates. Is there any truth to that? And if so, can we expect a major pullback? I know we talked about a minor correction because of the things you talked about, but because of restrictive policy, can we expect a major pullback?
I think that's a misnomer that's unsupported by data. And particularly if you look at data going back more than 5 minutes. And I'm speaking generally now because this is kind of a maxim in the market. This is not something that you just invented. This is what everyone's saying, and you're absolutely spot on. But let's just take a look back beyond the last 5 minutes and look back to the late 90s when you had the biggest tech rally in the history of the NASDAQ from 95 to 99/early 2000, and you had the Fed funds rate just about 6 to 6.1%. And it stayed elevated for much of that 5-year period. And yet you saw the continued growth because of why? The advent of a new industry, i.e. the internet, which was going to increase productivity and change the world. And the answer to the question is, did it change the world? Unequivocally, it changed the world. But, when there's excess pricing in the benefits for decades to come all at once, that's why we saw the pullback in 2001 and 2002. I think as it relates to AI, a similar type of narrative, it's always a little bit different. And I think there will be some companies that get far too much credit and they'll crash. But I think this time the leaders, they're highly cash generative companies that are established. We're not betting on eyeballs. We're not betting on promises. We're basically making bets on profits. In some cases, we're giving multiple expansion and a little bit of re-rating to the upside, but not seeing the level of excess that is prevalent when you're really at the peak of a bubble. I think this is kind of starting, and I think Microsoft did a decent job tempering expectations yesterday, saying, hey, the demand for compute and generative AI is unlimited, but there's going to be some costs for us rolling it out. Our CapEx is going up. And it's kind of this nuanced, perfect balance where people expect good things, but they're grounded in reality. And I think that's very healthy. And that gives us a longer term runway as we look at risk assets.
How do you respond to the argument that risk assets overall, and especially the tech sector, are overvalued, valuations are overstretched, and the risk-reward profile just isn't there right now to be long?
I tend to agree to a point in terms of our earlier thesis that they will underperform relative to what didn't work in the first 5 months of the year. Small caps, banks, REITs, some of these other groups, some industrials, some healthcare, et cetera, that are playing catch up. As it relates to the general market, though, it's very interesting what's happening this time, David. One of the data points I look at besides commitments of traders is the Bank of America Global Fund Manager Survey. And it's so interesting. You would have thought this month, a survey that just came out a few days ago, that sentiment would have been through the roof, like you're starting to see with retail investors, the AAII sentiment survey and the bullish percent, et cetera. Institutional managers, they remain bearish. They're bearish at the levels, their sentiment, their growth expectations are below COVID levels, and they're at great financial crisis lows. These are levels you see at bottoms, not on tops, which is mind-boggling. The other thing that's very, very interesting about this cycle is very similar to the COVID lows in March of 2020. Who do you think bought the lows in March of 2020? Who was smart enough to buy, Exxon when it was trading at $30 and Wells Fargo when it was trading at half a book, and all of that, and ride the first 5 months of the rallies? Was it the institutions who were smart and said these valuations are too low? Or was it the quote unquote dumb money, the retail traders? And it's counterintuitive, but you know who got it right and who got it wrong? the retail trader got it right. They were the most exposed for the massive part of the rally from March, April through June, July of 2020 and then beyond. Institutions didn't start catching up until most of the rally was already in the rearview mirror by the end of 2020, first and second quarter of 2021. And then we know what happened in the beginning of 2022 once they were all in the boat. They pulled the trapdoor opened and they were toast. The exact same thing is happening this time around since October. All of the quote unquote dumb money has been buying this rally, and they're up 30% off the lows, give or take. And the institutions are still skeptical. As a matter of fact, there was another data point. They said, what level of risk do you think you're currently taking in investment? It was the lowest level since March or April of 2009, the great financial crisis lows. After the market was rallying, they were missing the whole thing once again. So history is repeating here. The retail investors are getting it right against ahead of the institutions, and the institutions are going to desperately play catch up. They're not going to play catch up buying, Meta up 250% or Nvidia up monstrous or Microsoft. They're going to buy all these groups that failed to participate in the first 5 months of the year, and they're going to ride those up for monster gains into year end so they get to keep their jobs.
Well, have you seen any data for retail sentiment and positioning right now?
It's exuberant, okay? And the thing is, where everyone gets faked out is in the first move off the heart attack collapse, which we saw in basically October, November of last year. Indicators get overbought pretty quickly. And right now they're overbought across a wide spectrum. And retail sentiment is getting towards the extreme of bullishness and exuberance. And in ordinary conditions, after the market's been trading sideways for a couple of years, at those levels, you benefit from taking the other side of the trade, taking the other side of the exuberance. The problem is in the first move off the heart attack low, what gets overbought has a tendency to stay overbought. And what I like to say is stay pinned for a while until everyone is in the boat. And what we know from institutional positioning and data is they're not all in the boat yet. And therefore we can push higher. And unlike most years where we'd be going into the fall with this level of kind of enthusiasm, I'd be looking for a 10, 12, 15% pullback in the fall and then a rally into year end. I think this time's going to be different. I think the 3 to 5% pullbacks that we may get in this volatile, softer period are going to be bought, and they're going to be bought aggressive by institutions who are underweight. So maybe some bumpiness, maybe some 3 to 5% pullbacks, but they'll be readily bought. And those praying for the 10 or 15% pullbacks because they didn't get positioned in October or November of last year are going to be sorely disappointed and left behind once again.
I've heard as high as 5,400 on the S&P by next year. Is that something that's likely, you think?
I think that's pretty high. I mean, we have to see earnings start to catch up. I mean, it's normal for the multiple to expand aggressively off the lows, and then the earnings numbers start to come up. I mean, we came into this earnings season with extremely low expectations, negative 7.1% earnings growth. Next quarter is supposed to be modestly positive, and then the fourth quarter is expected to be up 7.6%. So we need to see that guidance kick in and support the multiple expansion that we're starting to see. I've got my mind on 4,800, I think is a reasonable level. Do we do it before the end of the year? I think that is probably a realistic outlook. And then looking into the election, so that would be another 10%, that would be another 12% next year. It's possible. I think it's pretty aggressive. I think if you got to that level, you'd have to be looking out to the end of next year and you have to see earnings start to support. But I don't think that's the game to play. I think those chasing the S&P up 30+% off the lows in October are going to be sorely disappointed because you're not going to get the 18% in the second half that you got in the first half. You might get mid-single digits. It'll be subdued. The leaders of the first half will be more underperformance, namely the Magnificent Seven, long duration big tech. But the opportunity, you can make monster money under the surface in the groups that didn't perform as well in the first 5 months. And in the second half, you're going to see stocks up 30, 50, 70%. and that's where you're going to make your money. So I'm less focused on 4,800 or 5,200. I could care less. I'm not betting on the indices. I'm looking at what's still left that's going to participate and going to move aggressively in the next 6 to 9 to 12 months.
Is there anything that could significantly change your positioning over the next 6 to 12 months? In other words, if you were to, go back to the drawing board and say, let's reposition everything, let's get more defensive, perhaps do the exact opposite of what you're doing now, what would need to happen, hypothetically?
I think if Powell did hike again in September, I would take a second look at everything that all of my core premises and start to look at what would be the lagged effect. It's kind of like, I think we're teetering on the edge. I think if he pushes it too much, we're going to go over. And if he pulls back just in time, we're going to live another day like nothing happened. Just some data on small caps. I know I've mentioned it a bunch of times, though. There have been 10 occurrences in the last 40 years where the trailing 1-year returns were negative for more than 6 months. That's the condition we're in right now. Actually, it's been 17 months, and that's only happened one time since 1982. The net effect is when you've had that happen, negative trailing 12-month for 6 months or more for small caps, the average forward 1-year return is plus 25%. So while everyone's cramming into the S&P 500 right now, they're going to, at best, get 5-8% before the end of the year, whereas in the small caps, and it's already started to move a lot, but they could probably double or triple that and be in a very good position by skating to where the puck's going versus where it's already been, looking through the rearview mirror.
Excellent. Well, where can people learn from you and look through not the rearview mirror, but look ahead, so to speak, and gain more from hedge fund tips?
Well, thank you. I mean, we have a website, hedgefundtips.com, but what's become very popular and the number one podcast in the hedge fund niche by FeedSpot, it's called Hedge Fund Tips with Tom Hayes, is our weekly podcast, VideoCast. You can search on youtube.com or just put it in Google and it will come up, and you can listen to it or you can watch it, and people find that extremely valuable. It's free, and that's probably the best way to get to know us.
Well, congratulations on the success of that podcast. I'll definitely put a link in that description down below so people check it out. Thank you very much, Thomas, for your time. Appreciate it, and we'll speak again soon.
Thanks so much, David.
Thank you for watching. Don't forget to subscribe.
And we're back. So there you have it, the playbook. David always asks the best questions, so I hope that was helpful. And then this morning at 4 a.m., I had a chance to get up for CNBC Indonesia, their closing bell, my opening bell, I guess, to put it mildly. And we went into more detail on emerging markets. And when I say emerging markets, I really mean China. That's our focus with Alibaba, of course. So we're going to listen to this segment. I want to thank, obviously, David Lin for the last one, and Safrina and Fitria for having me on CNBC Indonesia this morning. Here we go.
Mengulasnya bersama dengan Chairman and Managing Members of Great Hills Capital, Thomas J. Hayes, bergabung dari New York, Amerika Serikat. Good morning from New York, Thomas.
Good morning, Safrina. Nice to speak with you again.
A pleasure to have you in Closing Bell CNBC Indonesia. So, Thomas, the Fed finally approves hike that takes interest rate to highest level in more than 22 years since 2001. What's your take on this?
Well, I think the big takeaway that is kind of a headline catcher here is that the Fed is done and they just don't know it yet. So between now and the September meeting, we're going to see 2 more inflation prints, which are going to be very important, as well as 2 more job reports. And if you look at the most recent data, they actually had enough data to give them cover. If they wanted to skip or pause in July, they certainly could have, but the market priced in 1 more hike and they went ahead with that hike. But looking back at the PPI, came in near deflationary levels. That's the wholesale prices, which precedes the retail prices. That came in at 0.1% year on year. And our CPI, as you know, came in at 3%, just a tick above a 2 handle. as well as the jobs report, the most recent jobs report. We had 209,000 non-farm payrolls, which was the lowest job creation in 19 months. So all the data is there, Safrina, for the Fed to skip again or pause in September. But what's important to understand is they can't just skip and say, okay, let the market go wild. They have to continue to talk hawkish to keep inflation expectations lower so that people's behaviors don't change. And that's where they're succeeding with 5-year inflation break-evens right now at 2.24%. They're basically at target.
They had to continue to even keep talking hawkish to maintain the inflation expectation to be around 2%. And how about the inflation target this year? What do you think? Is it going to reach the 2% finally at the end of 2023? In your opinion, Thomas?
I think we will see a headline inflation print with a 2 handle, probably high 2s. But that's a fantasy. I think really we have 120% debt to GDP. The last time we had debt to GDP this high was after World War II in 1948. And what they did to get rid of the high debt to GDP is they ran inflation between 3 to 5% for 5 years. And they inflated it away from 120% debt to GDP down to 63%. So I think they need to run inflation a little bit above trend to bring down our debt to GDP ratio. You know, ordinarily what you would see is when the Fed funds rate exceeds the inflation rate, and their preferred measure of inflation is core PCE. We're going to see that on Friday. It's expected to come in 4.2%. With the Fed funds rate at 5.25 to 5.5, they should absolutely be done.
Right, Thomas. And still on the interest rate, the markets and the policymakers has indicated at the June meeting that the 2 rate hikes are coming this year. And markets are pricing in a better than even chances that there won't be any more moves until this year. What's your take on this? Any more move from the hikes of the Fed fund rate still coming up until 2023?
I think they're done, Safrina. I think this is it. I think now you're going to have a massive tailwind and a massive amount of foreign investment start to happen. Emerging markets are going to be the beneficiary of the Fed being done. And I think the theme moving forward is that the dollar is going to continue to weaken, which is ordinarily highly correlated with emerging market inflows and emerging market equity rallies.
Right. And how will actually the increase in this interest rates, which have been very, very aggressive since March 2022, finally affect the Southeast Asian economy and probably the whole world?
Well, the U.S. was first in and they're going to be first out. So they were kind of first to start the aggressive hiking policy. And now we believe they're 100% done. I mean, the risk that they have on the table, looking at the most recent PPI print, is deflation, not inflation. So with that said, once the Fed is done historically and the dollar continues to weaken, you're going to see massive flows into emerging market equities. And I would put this, Safrina, very much like the rally from 2002 to 2007. You had a very strong U.S. dollar into 2000, 2001, and then it started to roll over, just like we've seen since October in anticipation of the Fed being done. It softened. It had a little rebound in May due to the debt ceiling negotiations, and it's resumed its downtrend. If you look back at 2001, when that descent started for the U.S. dollar, the weakness, it set the stage for what was the largest equity rally in emerging markets in history from 2002 to 2007. I think we're going to see a similar type of scenario as we look out for the next 3, 4, 5 years. Right. With a weaker dollar, emerging market equities and economies are truly going to flourish.
We also hear some interesting opinions that it is time for the Fed to give the economy time to absorb the impact of a past rate hikes, which have been very, very aggressive for this past 1 year. What's your take on it? How is the final scenario going to happen? Is it a soft landing one, the hard landing one, or what's going to happen?
Well, I think it can be a soft landing. I think the Fed is done. So basically, looking at the data, seeing the data between now and September, they will never acknowledge that they're done. I think what you're going to see is the data is going to continue to support them pausing. They're going to say, look, we reserve the right to come back in the market and add new hikes just to tamp down the long-term inflation expectations. But we think all of their tightening is now in the rearview mirror, and that sets the stage for positive growth moving ahead. The other thing we have to keep in mind, and I think they're cognizant of and a little bit worried about, is we passed a tremendous amount of fiscal stimulus in the United States infrastructure build with the Inflation Reduction Act, and much of that money is just starting to hit the market over the next 12 to 24 months. So it's going to be positive for growth, but I think the Fed is reserving the right to stay restrictive just in case all of that money hitting the economy leads to some type of short-term resurgence in inflation, which we expect that it won't based on the trend of the inflation numbers. But I think they want to reserve that right to tamp it down because that's a lot of money that's going to hit the economy. Yeah. It'll be good for the economy. It'll be good for jobs, but we have to keep an eye on inflation.
Yeah, for sure. And what is the relation between the Fed's interest rate policy and also the inflation in the United States and its impact on the international trade in the U.S. itself?
Yeah, well, they've collapsed inflation. You know, headline inflation's dropped from 9.1% just over a year ago to 3%, and we'll start to see high two handles in the coming months due to owner's equivalent rent and high base effects, et cetera. So with a strong dollar, which we've had in recent years, it's really incentivized us to be massive importers. And I think going forward, we're going to see more export, more domestic investment, et cetera. And it changes the theme. The other thing the theme that changes is, I think the outperformance for equity markets and investable dollars in the U.S. are going to start to go to emerging markets because that's where you're going to see the massive growth with the weakening dollar in the next 3 to 5 years. So I think there are massive tailwinds. I think the emerging markets are going to be the major beneficiary, including Indonesia.
Hopefully, Thomas. And now moving on to the markets, some curiosity about the markets, especially in the U.S. The Q2 2022 earnings season is almost upon us in the United States. And, you know, we see some macroeconomic headwinds remaining fairly strong in many markets. What's your take on this? Is it a good sign for U.S. markets and also global markets, Thomas?
Yeah, so we're in Q2 earnings season right now in the United States. And like we always say, the secret to happiness, whether it's in life or in markets, is low expectations. And we came into the Q2 earnings season expecting negative 7.1% earnings growth. And what we're starting to see is better guidance than expected, mostly better earnings than expected. And we'll see, I think, improvement throughout the earnings season. On average, it improves about 5.3%. So with that said, we could go from a negative 7% expectations to potentially finishing out negative 2 or 3% like Q1. And that would exceed expectations, which would force analysts to take their numbers up for the back half of the year. And I think based on institutional positioning, I think you're going to see a huge catch-up trade chasing stocks that haven't performed into year-end.
Does this good sentiments that the Q2 2023 earnings season will also bring to the U.S. market will also having a good contagious effect to Southeast Asia's economy or emerging countries and emerging markets like Indonesia? Your take on this, Thomas?
Yeah, no question about it. And I think the other theme that very few people are paying attention to for the second half of the year is with the weakening dollar since last October, we're going to start to see that hit U.S. multinationals, particularly those that get more than 50% of their revenues abroad, hit their earnings positively in the second half of the year, which is not baked into most models at this point. And I think those earnings beats are going to be very positive for the U.S. markets. It's going to be very positive for emerging market flows and a tailwind for the global economy. So I know there's been chronic pessimism. We haven't participated in it. We were actually on your show in October and November, pounding the table to buy stocks when everyone was selling them, saying we would go lower. But we think that we're in a constructive period. In the U.S., we don't anticipate we're going to replicate the returns that we had in the first half. In the second half, in terms of the general indices being up 18% year to date. But even if we got mid-single digits to maybe high single digits, The money's not going to be made chasing the indices at these levels. We believe the money is going to be made under the surface, starting to rotate in those areas that haven't performed in the first half. Most importantly, emerging markets in China is going to outperform in the second half, we aggressively believe, as well as multinationals that get much of their revenues from abroad.
Now, we're also moving on to some international trade issue. We currently see about the trade wars going on between U.S. and China. What is the impact of these trade wars and other trade conflicts on the economic growth for both United States and also the global economy? Because as we've seen here, we have some opinion about America's love of trade sanction will be its own downfall. What's your take, Thomas?
Well, number one, I would never bet against America, so I wouldn't worry about America's downfall. However, I think policymakers need to be responsible that we are more interdependent than ever, and posturing on a one-way, hard-in stance doesn't serve anyone. It doesn't serve the U.S. It doesn't serve the international countries. What I will say is I do believe we've hit peak trade war, and it's starting to de-escalate. Whether you've seen Janet Yellen go to visit, Jamie Dimon go to visit, all the business leaders, all the political leaders, John Kerry, Yellen, et cetera, starting to go over. The key is that Blinken visiting several weeks ago, the key is dialogue has begun, negotiations have begun. Both sides are starting to dial things down a little bit, and I think that's a huge positive for the United States. I think it's a huge positive for China, and I think it's huge positive for the global economy.
And we hopefully seeing better things coming up until 2024. And furthermore, what are actually the main challenges faced by emerging markets like Indonesia and other Southeast Asian countries in achieving sustainable economic growth despite so many uncertainties in global economy?
Well, you not only have the currency tailwinds, you have the demographic tailwinds. Much of the emerging markets has a young, educated, vibrant population, which is the key component in the formula to financial and economic success. So the key is the tailwinds are in your favor. The currency tailwinds are in your favor. Just don't screw it up with bad policies, is my best advice to Southeast Asia. As long as you keep your economies open, as long as you keep going with investment, allowing foreign investment, doing friendly trade policies, working together, I think that the future for the next 3 to 5 years in terms of outperformance of equities is going to belong to emerging markets, including Indonesia, which has one of the best demographics in the region, has a democratic government, and very positive things happening, natural resources, all the components you want to see in a growth story over the next 3 to 5 years.
Thank you for that, Thomas. And lastly, a brief update about the debt situation in the United States, which have been a really great issue for the previous 2 months. How is it going, Thomas?
Well, they're going to have to inflate it away. So as much as Powell continues to talk about 2%, I think they've got to let inflation run above 3%, 3.5% for the next handful of years. That'll bring our debt to GDP down, debt to GDP ratio down. It will make the interest servicing more acceptable, and we'll get back to long-term strong growth that we've experienced for over 200 years. So we've been here before. The key is to do the right policies, not to get too tight over at the Fed, and it'll take care of itself in coming years with growth and with increased standard of living. So we're very sanguine on the outlook for that situation.
Truly, truly wishing for the best for the United States, as what happened in the United States will also impact the whole world. Thank you so much for having your time with us in this discussion with Closing Bell CNBC Indonesia. Thomas, always a pleasure to have you with us. Thank you.
Thank you, Sabrina. I appreciate it.
And we're back. So now you got the U.S. playbook, the emerging markets playbook. Want to thank Meta Singh for including me in her article on Reuters this week, as well as Bansari Kamdar and Johan Cherian for including me in their Reuters articles.
Want to thank Nick Saltarelli, the CEO of Midday Squares, for sending me some of his chocolates. He's been an avid follower of the podcast for several years and a big fan. Always gives tons of love on social media, lots of likes, lots of shares. We appreciate that tremendously. And he sent these cookies and cream and the peanut butter. The cookies and cream were a home run with the kids, so thanks for sending that out. And you can check out his stuff on middaysquares.com. Young guy, aggressive guy, and his goal is to build a $100 million business. And then I'm sure he'll lay off $5 or $10 million for me to manage, which will be absolutely incredible. So we'll come full circle. Going back to the, also, by the way, want to thank my friend Chris, who just sent me an incredible golf hat that I'm going to be wearing to play in a member guest tournament. I'm excited. He just built a golf course in Texas. I'm not going to give too much color because I'm sure he appreciates his privacy. But the course he just built, I can't wait to get on it. It's going to be hosting numerous PGA events. It looks absolutely incredible. And I get to wear the hat probably before most everyone else. And probably in a year or two, you're going to be seeing these hats everywhere you look. So thanks for that. Meant a lot. Okay, so here is the kind of market overview. Thanks to my buddy for sending it out, who will remain anonymous by choice. And but you know who you are, and I appreciate it very much. So we can kind of get a bird's eye view of where the market is. And as much as, you know, everyone's worried about overbought and all this stuff, yes, we're overbought, and we'll get into why we can stay overbought, why we can get pullbacks, but we think pullbacks will be bought, as we covered with David Lin. But this looks like it could have some room to run. It seems to want to work higher, whether it's going to do it now or it's going to do it at the end of the year to push through to new highs. It really doesn't matter. We just want to pick up quality businesses that are still on sale, left over from the COVID once-in-a-100-year dislocation. And many people got the clue. We've been absolutely overwhelmed in a good way by all the inflow. If we had known that many people wanted to invest at the 1 million a level, we should have done it much sooner. So first off, I'm grateful always, and most importantly, to the people who have been with me since the beginning. You know exactly who you are, and you've been absolutely incredible. Very grateful for you. Very grateful for all the new interest coming in, and we did hit the target that we wanted to do for this round. So the new inquiries, and we talked to 5 people today alone, you'll be able to come in, but we won't be able to fund and get you going we'll probably be on a 45 to 60 day lag here. We want to get everyone up and running who came in the last 2 weeks, and then as you send in your subscription documents, you'll be first on the list to go live in 6 to 8 weeks, which is, you know, perfectly fine. And in the scheme of things, it's no time at all. And then hopefully after that round, we'll be able to keep it more open on a more regular basis without delays and limits. So that's where we go. Thank you. Grateful for all that. So seasonality, as we can see here, we're coming into a seasonally weak period. The difference this time is institutions are underweight and pessimistic, so we anticipate that any and all 3 to 5% drops over the next few months will be met by institutional buying of people trying to catch up to the indices that are dramatically underperforming this year. We'll go into that a little more on the article of the week. But even you can see the NASDAQ, so it's getting up to these, I guess these are Fibonacci retracement or whatever. So you pay attention to it. In the scheme of things, it doesn't really matter, but I just want to give you a clue on where we are now. I mean, the Dow Jones looks like it's actually breaking out of this quote-unquote cup and handle, so this could potentially move up to new highs sooner rather than later. I think the Russell looks best on a value basis. You know, on the catch-up trade, hasn't moved yet, just starting to move relative to the S&P, and that's why we emphasized it so much with David's incredible interview. Equal weight is starting to move. We talked about that for many weeks, and it's gone exactly straight up since our sea change report on June 1st, and that will continue. Percentage of stocks above their 200-day moving average. As you can see, when you come off the heart attacks, this gets overbought and stays overbought for multi-years. and we're not even at overbought levels yet. So as much as all the smart people, quote unquote, who told you to sell when the market was down 27% last year because they said it was going to go down another 20%, those are the same people now saying market's overbought, get out, take profits, because they're just praying to dear God that they're going to get a 3 to 5% pullback that they can buy because they missed the whole thing and they have major career risk into the end of the year. So just, if you own great companies, just suck up the volatility for the next 60 days if we even get any. The pain trade would be if we keep pushing higher and these guys never get a chance to get in. That's max pain based on positioning and sentiment right now. And that's common off the push off of heart attacks like we covered with David Lynn. The first move, it tends to get overbought and stay pinned overbought. And certainly we could see the sideways consolidation that we covered last week and the week before. But we wouldn't be saying, oh, it's bounced 30%, let's go to all cash and wait for the October crash so we can buy it. That's a loser's game. And we're not going to play it, and we're not going to screw our clients from a tax basis just so you can avoid a little short-term volatility. If you're investing with me, you know what I'm all about. High-quality business, take a 3-year view, get your multi-bagger, cash out, and get above average returns over time net of fees is what we set out to do. So US dollar index, this continues to break down. We're getting a dead cat bounce here. But the next target, according to this, is 98. I mean, I don't pay a lot of attention to this, but I thought the chart from last week, comparing it to 2000 to 2001, before the massive small cap and emerging markets rally from 2002 to 2007, was apropos, and it was at these levels consistent with, as a matter of fact, let's try to pull that up. Does this go all the way back? Oh, okay. Where is the US dollar? Currencies. All right, so yes, perfect. So the chart we showed last week kind of said, oh, this is like this as an analog. And, our base case is not that this multi-year downtrend persists for 5 years, although it's not outside of the question. We just need this softness to remain and emerging markets will take off. If the dollar weakness persists because the Fed's done before everyone else, which is kind of our base case, then I think you're going to see another situation from 2003 to 2007, the biggest rally in small caps and emerging markets that you've ever seen, which is why our kind of framework moving forward for the next few years is to be overweight in those groups and underweight in the groups that have had the rear view mirror looking performance, the windshield looking performance. We think emerging markets and small caps is the best value per price, what you pay versus what you get. So that's the dollar. Canadian dollar, no one cares. Sorry, my Canadian friends. Although if you have the loonies, hang on to them, ladies and gentlemen. You're going to feel rich in a few years. That the Canadian dollar is going to be going up, U.S. dollar is going to be going down, and before long, the Canadians will be buying Rockefeller Center like the Japanese in the mid '80s. With their strong loonie, they'll be coming down here on their ice skates and buying everything in sight. Okay, I'm going to get some blowback for that one. I think that's it from this table here. Google beat earnings. That was really good news. Cloud's growing. YouTube ads are growing, so their ad business is coming back, and that's good to see. Oh, this is interesting. This guy's pointing to the reverse head and shoulders in Alibaba, which we've been talking about for a number of weeks. It's setting up and playing out. So the first resistance he's pointing to will be around 120. We agree. And then what's his magic? Oh, the magic retracement. We've been talking about 180. He's got it at 188. Good enough for government work. That'll be the second resistance as we get going here and as the China bazooka comes out, whether they like it or not. Why do I say that? Because it's just like COVID zero. They were saying we're going to lock you up forever until there were people rioting on the streets. And then all of a sudden they flipped overnight and said, hey, if you want COVID, everyone can get COVID. We don't want to get carried out of the palace on a stretcher. Have at it, get COVID. And within 3 weeks, the whole thing was over and people are back to it. I think the same thing will be the case with the Chinese youth unemployment, greater than 20%. You don't want a bunch of educated 20-year-olds who are restless, angry, and intelligent. That's the worst kind of anger you can have. So they're going to do everything they can to boost the platform companies to get these kids employed, and that's going to help Alibaba, Tencent, etc. And they'll do it sooner than later. In the case of COVID, they waited till they didn't have any choices. I think they're getting to that point here, and you saw some movement with the Politburo meeting this week, and as such, a bounce in the stock. So that's a positive thing. Financials we've been talking about. The exploration production, they've basically done nothing for a year. I'm trying to find something that has an interesting enough risk reward, but they just didn't come down enough for me. I mean, I think we're just still stuck in the natural gases. Like, this was the 2020 trade when we were talking about it. Right now, the risk reward is like, you'd have to find some discrete companies. Obviously we have Range Resources, but that's already up a lot. Comstock. We'll see if we can find any other, but they literally just didn't come down enough for us. We'd rather focus on emerging markets and small caps, which is financial weighted in the small cap space. Herb Lash wrote this great article today about the why is the S&P down. This is the most important thing that happened today, which was a catalyst for for a breather in the market after 13 straight up days on the Dow, was that the Nikkei newspaper reported the central bank will maintain its 50 basis point cap for the 10-year government bond yield, but discuss allowing long-term interest rates to rise above that level by a certain degree. Reuters confirmed the central bank may make minor tweaks to extend the lifespan of its yield control policy. So this was a big deal. The market shoots first and asks questions later. Why? Because Bank of Japan is the lender and liquidity provider of last resort, as the US is still tightening, ECB is still tightening. But as the US ends, which we anticipate with the 4 important data points over the next 2 months, they'll have no choice but to. They'll call it skip or pause, but they'll be ending. Then it would make sense that Bank of Japan can start to ease up on their yield curve control as the US stops tightening and effectively moves into a more accommodative stance moving forward. Then we no longer need Japan as the lender of last resort. So this makes sense, but the market is over extrapolating. The market's a little overheated. This was a good example good excuse rather for the market to take a little breather. So that's the cause of today, if you're wondering. But these are the most important things to me. I look at the commitments of traders and what are the smart money doing. The commercials in green, they're buying. They buy before big rallies. They're always early and they're always right, just like the COVID lows. They've been buying like never before in the last couple of months, and things are starting to take off. And keep in mind, even after they stop buying, the rallies tend to persist for a couple of years. And I think that's going to be the case this time as well. The US dollar we talked about, and then the 10-year note. I think that's going to be the surprise trade of the back half of the year, is that we're going to find a bid in the 10-year treasury, which will mean a compression of rates towards the long end of the curve, similar to what we saw here as this starts to come down and you have a bottoming and a rally, and buying ahead and a rally, and massive buying ahead here. I think the 2018-19 and a rally, and same thing in 2000 when you bottomed out. Dollar was weakening. You got a rally from 2001 and beyond. So I think that's going to be a surprise trade, and we discussed a little bit of that. Ford reported earnings after the bell. It confirmed everything we've been saying about GM and Cooper Standard. They took guidance up on the basis of demand increasing, and that was a positive report. I think they're still up after hours. Don't really care because they're losing money on the EVs. The key is they're producing a lot of boxes with wheels on them, and when they produce boxes and wheels on them, they need sealing systems, fuel delivery, fluid transfer, and Cooper Standard's the best game in town. You can see their units up 5% year on year. And actually, is that the right division? Commercial customers produced 22% revenue growth. E-revenue up 39%. Don't really care. Here are the wholesale units up. So it's kind of a reflection of what we saw with GM earlier in the week. And then this is from Seth Golden talking about breadth. The S&P equal weight has been outperforming the S&P 500 for 2 months now. That's kind of right in line with our June 1st article on the sea change and the regime change that we're seeing in action in fits and starts, but mostly starts because it's going and it's going to persist. This is from Ryan Dietrich. S&P inching closer to a 5-month win streak, just like everyone expected. Wink, wink. Yeah, no kidding. No one expected. There was a handful of us. Ryan was one of them. Take note, higher a year later, 26 out of 28 times. Average return 6 months out is 6.2, which, by the way, is in line with what we were talking about with David Lynn. If you're chasing indices, you're going to be dissatisfied because you may get mid to high single digits through year end. The big money is going to be made under the surface. And 12 months out, you're up 12.5%. So that's the story there. And moving along, Amazon asking some, okay, we covered that, I think, last week. GM raises profit outlook, tops estimates. So they got a charge on their recall and I think their EV business. But the key is their units are going up, and that's all that matters for Cooper Standard. Let these guys all duke it out and price cut each other and produce tons and tons of cars. And Cooper Standard will take it all the way to the bank. This was the CEO of Boston Properties talking about the difference between A properties, B properties, and C. Boston Property is basically the equivalent of Vornado in terms of quality, and he lays it out. So we posted that in our daily reads. You can check that out, or just go to YouTube and Google this: commercial real estate sentiment versus reality. And that's why Vornado keeps going up and no one can figure it out, except those of you who have been listening for the last few months and got some at, in the low teens to the mid teens, and now you're in the 20s and off to the races. So we were wrong. Morgan Stanley's Wilson offers stocks mea culpa. So this is one of the, look, no one gets it right all the time, but, this was kind of the poster child of consensus, which was 95% of people who, when you were down 20%, said you were going down, 25% said you were going down another 20%. Some of the heads of the largest hedge funds in the world were aggressively saying that when you're down 27%, get out at the bottom, and because we're going down another 20%, and instead we rallied 30+% and more off the lows, and no mea culpas from them. But so now you're seeing a lot of capitulation among the bears. You start to think, okay, are we getting a little frothy if these guys are starting to flip? If you read his report, it was basically 16 pages of I'm still right, but I was kind of wrong, but I'm going to be right. I don't think these guys certainly aren't all in. And if you look at positioning, institutions are not in yet. They're just not fully in. Retail is, but they were the first 4 months of the rally from March 2000 to June 2000. And when it was overbought, everyone said, see, we're going back down, and we just kept going up. And that was that. 3M beat this week, which was great. Improvement of margins across the board. Stocks up. So that's good news. Raises full year profit forecast. This is what I was talking about, ladies and gentlemen. These acute things, these settlements and different things, they are one-off events. The market, once the market can quantify them, it can look through them. So that's why with the PFAS, you saw the market start to look through. When we get the earplug resolution in coming months, the market's going to put it in the rearview mirror, and then it's going to look at, wait a second, this is a business that compounds capital at 20% a year for decades, and I could buy it 11 times earnings, and boom, you're off to the races. So that was some good news on 3M. Google, we covered, beat earnings. And then Rolls-Royce, this is one we don't talk enough about. We talked about when we were initiating last year. It's up, I think, now close to double, at least 80%, which is pretty exciting. This was one of our UK plays. This one was in a lot more size than ASOS, but ASOS is the second one. And that's going to continue. So Alibaba put out their annual report. 360 pages of color and nonsense. The only page that matters is free cash flow. They generated $25 billion last year, and people continue to forget. And the stock is trading at 4 or 5 times free. What is it now? 8 times free cash flow, but just getting started. And by the way, this number is going to grow a lot now that we're coming out of everything. So hedge funds, people continue to forget that. They talk about the G and policy and this and that. I mean, in the worst scenario in 100 years, with the worst political climate, with the worst everything, they still generated $25 billion of free cash flow. And people are wondering, is this a good deal? Let me think about that. Because when this cash flow is at 50 and 80 and 100, when you start to get the cloud and the unlimited demand for compute and the spin of cloud, of Ali Cloud, this thing's just getting started. Hedge funds rush to buy China stocks on economy stimulus prospects, Goldman Sachs says. Thanks to Philippe for sending this over this morning. Global hedge funds snapped up Chinese equities following the Politburo meeting this week, buying on Tuesday at their fastest pace since October 2022. Goldman Sachs said in a report the higher inflows were led by mainland A shares than Hong Kong listed shares, while U.S. listed ADRs, mainly internet companies, saw smaller flows, the report added. They did not give any further details on volume, but highlighted the inflows were driven by long buys, to a lesser extent short covers. Consumer discretionary, staples, financials, industrials. So this will happen in fits and starts, but we know the story. We've been through it a million times, and now it's starting to play out. China's Alibaba says it will not join Ant Group share buyback. Why are they not joining Ant Group share buyback? Because Ant says, hey, if you want liquidity before the IPO, we're happy to take the stock off your hands. We're going to give you a discount to intrinsic value and have at it. Give us as much as you want. Alibaba said, we're not tendering our shares. We're going to take the IPO because we want a multi-bagger on what we own. And I love it. I love it. I love both what Ant is doing, buying back at a discount as an owner, and two, because I get a higher percentage of the company at a lower price. And I love that Alibaba is not participating with the other shares that we own through our 33% ownership of Ant through Alibaba. So pretty exciting times there. Rolls-Royce takes the fast lane out of Pity City. So, I love the meme here. Everyone said it was a burning platform, and now it's not, and the stock's up, double, almost 3x now, which is, and it's just getting started. So we're pretty excited about that. All that has to do with international travel coming back in the last 6 months. It's just getting started, and China is just getting started, which is going to be a huge, huge part of this. This is basically a China play as well. And that's what we do. We buy high quality when it's marked down. And as you can see here, it's literally just getting started. Moving along, Ant IPO gets back to where it all began. And basically the point that Brendan Ahern is making here, the guy who runs KWeb, is that if the sell-off started with the pulling of the Ant IPO, the recovery, the durability and the confirmation of the recovery will be marked by the initial stages and ultimately filing and activation of the IPO of Ant Financial, since they've taken all the steps in that direction. And we agree. Moving along, China state media says stimulus measures for capital markets anticipated to be launched intensively. I think what they mean to say is imminently, but intensively works just fine. Alibaba Cloud to support Meta AI model for Chinese users. Why it's a big deal. You should read this article on Barron's. Chinese stock set to bounce back in second half as strong corporate earnings revive confidence, says UBS and China Asset Management. Article of the week, more good news stock market and sentiment results. So we already went through the CNBC. We went through Cooper Standard many times. We put it out on the Clayman Countdown twice. If you listen to that or the podcast, you're up either 2, 3, or more X. Talked to a guy today that bought a ton around 4. I think we closed at 17. So that's pretty good. GM we covered with their demand from their results. And I love the Cleveland Cliffs CEO telling the host he's too negative. Auto production is through the roof, best since pre-COVID. And the host is like, but. And he's like, man, you need to work on your attitude. It was unbelievable. You should listen to that. Made my day. This is when we were talking to Charles Payne when everyone was down on 3M. Now the thesis is starting to play out. I'll be on Making Money with Charles Payne, and that's what makes him so great. He's willing to have managers who go against the grain versus many networks that just want to push the herd narrative. He's an independent thinker, along with Liz, who had me on to talk about Cooper Standard, and that's what makes the network and their shows fantastic. Tune in Tuesday at 2 p.m. if you're around. That'll be a lot of fun. And this were the upgrades from Bank of America after beating. Better than forecast margins across segments, strength in autos, raise our price objective. And you can see, looking out here, they're going to do over $10 a share in next year and almost $11 a share. The stock's trading at 110. You do the math for a business compounding at 20% a year. It's a bargain that doesn't come along very often, and it's starting to reflect that following the PFAS. And there was a note out today that some DAs are saying, oh, that I don't know if that's a good deal now, so there might be some tweaks, but I think what's done is done, and the judge will probably uphold it, rather. Been up since 4 a.m., so forgive me. And then Baba, when I said on Charles' show a couple months ago, this will be the last chance to buy under $100, we believe that to be true. That's starting to play out now with the Politburo on the macro policies. They committed to reductions in taxes and fees, issuance of special local government bonds, which usually fund infrastructure investment. That's been their historic playbook. That works very well. They want to foster livelier capital markets, measure to diffuse mounting financial risks, and improvements in business and consumer confidence. So expect more of that to come. Proactive fiscal stance. Property, they removed a key phrase. They said at the last meeting, houses are for living, not speculation. That freaked the market out. Now they took that out. They're like, all right, if you want to speculate, please do. We need prices to stay up so we can get confidence back. And I think they're going to be able to do that. And then they're going to build some stuff, some more empty cities, i.e., quote unquote, more affordable housing led by state-led projects. That's always worked in the past to bring them out of holes. Local government debt, they're going to kind of restructure debt for equity swaps and a soft extend to pretend, like you're going to see in commercial real estate. And the official strategy would go a long way to easing market nerves. Household consumption, Politburo reiterated it wants to turn it into a key driver of growth. Household consumption, intention to boost consumption of autos, electronic products, household goods, promote tourism, sports, entertainment, and culture. And finally, employment, which is the key thing that drives all of this, is they don't want 100 million 20-year-olds in the street rioting and carrying them out on a stretcher. So they need to stabilize employment from a, quote, strategic perspective, i.e., the number one job of a politician is to stay in power. Chinese leaders are concerned that a sluggish job market poses social instability risks, you think? Private sector to regain confidence and start investing, thus creating jobs for more than 20% of youth seeking employment. Politburo gave a nod to industries that have been bleeding jobs in recent years and are particularly attractive to university graduates, from artificial intelligence, i.e. AliCloud, the biggest player in the market, to the platform economy and advanced manufacturing. As for the rest, this is the regional banks are starting to take off, up 44% since May. Small caps are up 17%. So the regime change is well underway that we laid out in our June 1st article, saying two trends: dollar down, bonds up, which would lead to a bid in emerging markets in China, multinationals that have more than 50% of their revenues abroad, and as risk comes back, biotech. We didn't forget about biotech. Biotech's great. And while it sits in this range, it'll be an awesome opportunity to get exposure for some of the new money that's come over the transom and get positioned for that properly for the coming 12 to 24 months, which we're excited about. And then dollar down and bonds up. It was supportive for REITs, banks and small caps, and we're already seeing that. But you can see where they were when we put this out. They were all at their lows. The Fed, everything you need to know about the Fed meeting is summarized by these lines by Nick Timiraos following the Fed meeting. Quote, he emphasized how much the central bank had already done, along with the amount of time it can take for monetary policy to cool inflation, i.e. hedging. We've done enough. That's my color there, the last sentence. And quote, at some point that may change. Oh, he said at some point that may change. We have to be ready to follow the data, and given how far we've come, we can afford to be a little patient as well as resolute as we let it unfold. So we got the data dependent, that's the data David Lynn. And a friendly reminder we put out this morning before the market was red. Actually, it was green. We are moving into a seasonally weak period and volatility is to be expected. We anticipate the normal 3 to 5% pullbacks, if they come, will be met by large institutional bid playing quote unquote catch up into year end in an attempt to salvage performance that is devastatingly missing their benchmarks year to date, present company not included. We're having a great year and we're grateful for that. Now, on to the shorter term view for the general market. You can see these things are pinned. Bullish percent came off the boil a little bit from 51 down to 44. Bearish went up to 24 from 21. This can stay elevated for some time based on positioning coming to these levels, but it would not surprise us to see a little give back in coming weeks, even if we were to push a bit higher first. Keep in mind, institutional investors are nowhere near fully invested yet, so there will be persistent bid on any bumpy pullbacks through year end. That was copied from last week as well. Fear and greed still pinned at 80, down from 82, and the National Association of Active Investment Managers, let's see if that came down this afternoon at all, was at 99 this morning. It's at 101, so they're chasing, but as you can see off these lows, sometimes they stay pinned after that first spike. It doesn't mean things go right back down. And that's that. Now, top 30 weights of the XBI equal weight ETF, their cumulative earnings power has been revised down by 33 basis points in the last 60 days for this year and 148, 1.5% for 2024. But the price has come down a lot more. So it's just stuck in that range since last May. Let's just pull it up so we can zoom out and actually just get a reality check here. Feels like it's red every day, but basically it's just going sideways, up meaningfully off the May lows from 61 to 81. It had gotten up to 90, and it's very similar to what we saw in 2016 coming out of their tightening cycle. You get this first rally, you get a sideways consolidation for a half a year, and then you get another leg up, which would get you up to about 120 plus, and maybe even more, and that's monster upside. So you get these normal checkbacks on the way up, and then you continue to rock and roll. So that's what we're looking at moving forward. Same thing with the cap-weighted biotech ETF, top 30 weights. Same thing, down 86 basis points and 133 basis points. My guess is it's one company that's got a huge down, and it looks like Sarepta, by the way. SRPT. Is that Sarepta? No, I think that's a commercial. SRPT. What is that? Yeah, it is Sarepta. So that looks like it's dropped about $10, and that's probably skewing. So if you look ex Sarepta, which has gone from plus $2.32 down to negative $9, all the rest are kind of in line, and many of them have actually gone up. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, and 2 have stayed the same. So about half of them are up or flat, and this one that's down, the rest that are down modestly. It's this one that's skewing the whole thing down. So net of that, this is probably up a couple points, but anyway, good to get an overall sense. On to the Ask Me Anything questions. I know you guys like them, so and those of you who don't, this is where you want to tune out. But Greg Stewart, had a family in town this week and was talking to them about my investment strategy and could tell they were a bit skeptical, so I figured the easiest way to explain it was to play your latest segment on Yahoo Finance. Needless to say, they got my strategy after that, and I'm pretty sure you'll have some new followers. Anyway, thanks. As for my question, you have mentioned many times that you invested in Vornado because they primarily own A properties as opposed to B and C properties. My question is, how do you find out if a company owns A properties versus B and C? Greg. Well, number one, you always want to go to the source. So go to the investor relations. In the case of Vornado, they have their entire property book. They'll explain what they own in the annual reports, which you should be reading before you invest, the quarterlies, the quarterly earnings calls transcript. But in the case of Vornado, investor relations, you just go there and you see their whole portfolio book property by property. 316 pages. Does that look like B and C to you? So there you go. This is what you own. I mean, this is unbelievable, this stuff. All right, so that's the story there. Moving right along. Ite Naman, hi Tom, avid student of the podcast. Excited as always to watch the episode with my circle. Wanted to pick your thoughts about leveraged ETFs for the next year or two when you're bullish on the underlying. It seems to me similar use of options with less time risk. I know the theory of time decay and that these products are meant for short trading, but historically seems to work well if you're correct about the long term. I'd assume you like options. It should be sized conservatively. Yes, if you do options, it should be sized conservatively. You want to go as far out as you can, and you want to do so when implied volatility is at or below historic volatility, and generally do it deep in the money so that you're getting extra juice on the underlying position. Usually will be exposed 85-90% stock, and then 10 to 15% derivatives overlay to juice that. And there's a lot of nuance behind it, but that's the general concept. Those products are for special situations. I would probably lean towards just owning the stock and some leaps versus that at this stage. They can be very powerful, and there are right times and places to use them, but it sounds to me like you're relatively new-ish. I'd probably pass on that. Don't get too greedy. There are a time and place for it, but I would pass in the early. If you've been doing this less than 10 years, just do it. Do it right. Brian McLean, love the podcast. Basically started refreshing Spotify on Thursday at 3 p.m. until it comes out. I've been a devoted listener for about 1.5 years, just in time for the CPS call. So thank you very much for that. You're welcome. Thank you. Just initiated a starter position with AMT, which is American Tower, which I like a bit more than CCI, mostly due to the expansion outside of the U.S. Their growth in Africa is quite interesting to me. It could be a great long-term play due to demographics and increased mobile penetration use within the content. I suppose I'm most curious about why CCI is piquing your interest over AMT. Much interested in your feedback, point of view. Thanks again for all the information. So AMT is down 20%. No, a little more than 20%, 30, about 25, something like that. CCI is down 45, a little bit more. They're both probably, it's probably like Vornado and BXP. I think that, I played golf with a guy who owned a ton of these, private equity guy, and talked to him a bit about Crown Castle, just because he knows the space very well. kind of laid out my thesis on Crown Castle. I haven't done anything with Crown Castle. I'd probably still go with Crown Castle over American Tower. Let's take a look at. This isn't really going to tell me anything. I think you're okay with either. If you like American Tower, have at it. I just like a little more distress. You know, if I can get a little more juice out of the same idea and kind of basic equivalent quality, I want to do that. Let me take a look at CCI here real quick. Yeah, CCI actually added cash last year relative to AMT. I mean, it's a one-year thing, but well, where did that cash come from? Where is cash from financing? Yeah, I mean, these are basically like Boston Properties and Vornado. I just have a better understanding and color from people who actually know this space better. That I concluded CCI is where I would put money if I was going to be involved. Thoughts on First Watch Restaurant Group? This is from Jeff Adams. Fresh and promising daytime restaurant chain with strong growth potential in younger markets. Appreciate all you do. I think this is similar to Cava in the sense that they're not going to be able to expand with free money like Chipotle did. By the way, Chipotle missed today. I've had two really bad experiences in Chipotle. The one up here in Connecticut, their soda machine never works. They're kind of like their employees are completely out to lunch. And then when we were traveling for near Wesleyan, we went there at like dinner time, and every single thing was out. They didn't have any white rice. They didn't have any black beans. It's like, and they're all just standing around there. No one's making new stuff. They're just like, we're out, and they're just standing there, and they're not making new batches. It's just like, so there seems to be kind of this pervasive culture of hiring as inattentive employees as you possibly can, and maybe that's just a function of the labor market, but I don't see it at Pokeworks, and I don't see it so by the way, we walked out, and I went across the street to Taco Bell, which made me a little nervous because it was empty, and the food was super fresh, super delicious. I haven't been to a Taco Bell in years, and I reluctantly did it, but we had to get back home, and it was awesome. So, you know, kudos Taco Bell. Everything was in stock. Everything was fresh. Chipotle resting on their laurels a little bit. Got their faces ripped off this quarter. So hopefully they'll fix that quickly because, all right, let's get back to the question. First Watch Restaurant Group. First Watch Restaurant Group. FWRG. Okay, so what do they actually do? All right, so it's like a fancy breakfast place with a lot of drinks. So it's whatever that Bros thing, Dutch Bros plus avocado toast. So it's like Dutch Bros plus like Panera for breakfast. Looks pretty good, but they only have one meal a day, or maybe two. Oh, they have sandwiches. Yeah, it's kind of like a Panera. I mean, I can't predict this. That's not what I do. I don't predict what's going to be next. I buy durable, sustainable cash flows when they're temporarily in periods of dislocation, and I have confidence that they're going to recover in a reasonable amount of time, and I get a multi-bagger for the risk. This could work. It might work. I don't know if it's going to work. I might be interested in this in 20 years after they've gone up 10x, cut in half because they got some headline about someone got food poisoning from their chicken, and the stock drops 60%. And I say, 3 months, they're going to forget about this. The chicken will be fine. Let me buy it and get a double. That's when I'd be interested in something like this. Gabe Farhadian wanted, have you taken a look at CVS? They have growing revenues, free cash flow. Stock is beaten down to $75 from $105. That's not beaten down in my book. Blah, blah, blah. All right, let's take a look at CVS. I mean, we put this on for trade service, but we haven't really gotten confidence in this as a long-term play. Yet. That doesn't mean it won't work. Why are we all the way over here? Okay, CVS. Maybe I can pull up. Just get a one-pager so we can go through this quickly. No. All right, let's see. While we're doing that, maybe we'll pull it up here. I think your instinct is right, Gabe. I just think it's not a great quality business. Yeah, I mean, it's a low to single digit compounder that's only down 35% in a highly competitive business. They're just better things to do. I think this will work as a trade, but I'd be more interested at 50, 55 than I am at 75. That doesn't mean it won't work, but you know, you got Rite Aid. I guess they could be last man standing duopoly with Walgreens Boots Alliance. Let's see here. Let's see how much debt they have to refinance. Long-term debt, $56 billion, $14 billion of cash. That's going to be... It'll probably work, but there's not enough margin of safety. You're taking a mediocre quality business in good times. It's not impaired enough that you can count on getting all of your money back in a reasonable amount of time, never mind a double or triple. Like, I don't see how this thing ever turns into a double anytime soon. And that's just at first blush. I mean, maybe their healthcare business, the non-store business, what do they have? Aetna or something, healthcare benefit. Let's see. Yeah, it serves... I don't know. They've gone through a lot of transformation. They've taken on a lot of debt. They're in a lot of new business lines. I just think it's going to take too long to understand it and work out. I want things that I can easily understand that are going to work relatively quickly within 12 to 36 months. 12 months, so I get tax efficiency for my taxable accounts, and 36 months, so it gives it enough time to be a multi-bagger versus just, taking risk for a 30 or 50% return. It just doesn't make any sense because it could go 30% against you before you get a double or triple. So I think your framework is okay, but just look for a little more dislocation so your margin of safety is higher and a slightly better quality business, and you'll be well on your way. But well thought out, and thanks for sending. Eric Haney, are you concerned about the UAW employee contract that's set to expire on September 14th for GM and Stellantis? Can you talk about how this might affect Cooper Standard stock and how you might adjust your position accordingly? Thank you for all you do, and please don't change a thing. Yeah, the stock could be cut in half temporarily, but how does that impact the demand and the supply over time? And the answer is it doesn't. So you just suck it up, buttercup, and stop worrying about daily fluctuations, and don't trade on massive margin, and wait for this thing to revert to the mean. We're in this thing for $5 to $7 a share in earnings. So we'll either scale back when a good portion of that is already priced in, or when it's already delivered. But worrying about 3 weeks of shutdowns, which will push forward their demand by 3 weeks, it's just noise. Who cares? Like, honestly, I've got so much new money coming over the transom. I pray to God it gets cut in half for a couple of weeks because of the strike, so that I can get a lot more of exposure. But I'm not holding my breath. I think they'll get it done like the UPS people got it done. Especially with this administration, there's not going to be any sympathizers for the corporate side. Rob Notaro, thoughts on Data down 90% from all-time highs. Knows it's not something you're usually interested since it's too new and losing money. Well, there you go. You answered your own question. Rising tide lifts all boats. Why? Why do you have to make? Why would you risk capital for a potential when you could go with things that are more certain to work out? I mean, Data is on-demand retail and delivery into people. No, they're going to get smoked by Meituan and Ellie Mae. I mean, they're not going to be able to scale and compete. Let's take a look at the financials here. So their delivery was great when everyone was locked in their apartments. It seems to be flattening out. They are losing money, and they're not going to be able to scale along the likes of Meituan and Ellie Mae, who have the front running. They are burning cash. So where are they going to get more cash? They're getting it from financing by issuing more debt and common stock to dilute you, which gives you a little reason of why the stock's down 90%, because they just keep issuing stock to finance a money-losing project that has little likelihood of competing against the main players, absolutely destroying shareholder value. But other than that, it looks like a great idea. No, I think you'll probably win as a trade. I would never put anyone's real capital at risk, but I can see why you like it, and it could certainly go to $30, and it could also go to zero. So I don't like that asymmetry, because if zero is a possibility in the equation, it could go to 400 and I wouldn't be interested, or I'd really have to size it so small that, I think getting a little too greedy on these is why people fail to take a $250,000 account to $1 million, because they can't wait a few years to get 2 or 3 doubles. They try to get, an 8-bagger, and they go on leverage and they blow up their account, and then they can't make it back because they don't have any seeds. You can't destroy your seeds, and something like this could destroy your seeds, and you'll never get a harvest because you're too short-term thinking. Now, you may get lucky, and you may get a 9-bagger out of this, and then you'll feel so hot about your picking, you'll take the whole 9-bagger and you'll put it in another piece of crap like this, and you'll blow it out at $1 million instead of at $250,000. So you got to get the philosophy right. Otherwise, no matter how much money you make on a lucky trade, you're going to give it all back to the casino, because it's nothing more than gambling. All right, Joseph Cook. First, thank you. Please don't let the investors stop this great podcast of yours. I don't have enough yet to be one of your investors, but with your help, I'll definitely get there. Your podcast is invaluable. 2 questions. You've stated about some of the positions you hold something along the following. We own Bank of America and long-dated derivatives. Could you please expand on the long-dated derivatives? We actually covered that in the last question. Great question. Next, leaps. Okay, great information material. Don't stop. My sincerest gratitude. Thank you, Joe. We covered the leaps. And we've also covered the leaps as it relates to BABA. There's some risk, but it depends where they list. Go back 2 or 3 weeks ago. We covered that in details. Paul Smith, thanks so much, Tom. Someday we will meet, maybe a Vernado building, a Melco casino, or near a Rolls-Royce power plant. If it were today, of the following, which would be your first quick impression pick to hunt for some catch-up trades? IWM, XBI, FXI, EEM, etc. I think XBI, because it hasn't quite moved yet. Let's see. Yeah, I definitely like XBI on this kind of recent softness. IWM's moved a lot in the last month, so I'd wait for, I don't know if you're going to get a breather, but you kind of missed that one from the June article. FXI is probably okay. And EEM, yeah, it's moved a bit. Yeah, probably FXI is a little better than EEM. I mean, we basically have that as a proxy with BABA. So good question, Paul. And thank you, as always, for all of your support on social and engagement and sharing and liking and commenting. That's helpful. Jason Zen. Take a look at Farfetch. Their balance sheet may not be ideal right now, but it's in my portfolio for 6 months. I also found it in Bill Miller's protege's portfolio during the COVID lows as they evaluated that acquisitions and mergers deemed bad turned out to be good. Most recent quarters have gone through several management changes. Reebok partnership. I know a group that got roasted in this. I would probably pass on this because I think the winner is going to be ASOS, just because they have better scale, better history, better mind share. This is too new. ASOS has been operating for decades. I don't like playing these new plays because they're untested, and now you've got multiple managements. They're all still trying to find the coffee machine. So for me, it's a smallish position because I wanted exposure to the UK. I think it's going to be a good trade over time, but it's sized to not be as well. So this has never been a good steward of capital. They just continue to erode intrinsic value. Their margins are declining. Let's see, how much debt do they have? I mean, this is a quantitative view. Obviously, you have to do a qualitative. You have to understand the business. You have to go through it. Liabilities. Reasonably clean balance sheet. They've got some cash, although they've cut it in half, more almost 2/3. Revenues are flat for the last 3 years, losing money. I mean, this is exactly like that other thing. It's why take the risk? Jason Zen. Oh, we did that already. So I'd pass on that personally. Doesn't mean it won't work. It could certainly work as a trade, but that's not what we're here for. Seeing a few similarities in 3M. Patrick is seeing from AT&T. We covered that multiple times last week. It's always been a low quality business. If you want to do it for a trade, do it. If you have to pick Verizon or AT&T, take Verizon on any renewed weakness. Angel says, as a follower, I'd like to ask you if the strategy Cornwall Capital used to do based on buying long-term calls puts of low volatility beta assets still has sense now with higher interest rates. And if you still see mispricings and options with bimodal outcomes. And secondly, do you have opinion on Geo Group? We covered Geo in the past. It's a low quality business. I mean, it is a duopoly. It was a political game. It's Geo and what's the other one? CVX, of course. I mean, these are No, that's not CVX. Core Civic. I don't know what the ticker is. GO. But there are two of them in the prison business. When I looked at it a while back, I didn't love it. Let me just take a look. I know Michael Burry's into it, and I guess you're reading the Big Short books, and this is top line's going nowhere. So the only way to grow is to buy in shares, and to buy in shares, you have to have a ton of free cash flow. So let's see, how's that working out? They do not have a ton of free cash flow because they're buying back debt right now. So that could change into buying back equity once they're done with that. What does the balance sheet look like? $2 billion of debt. It's probably coming. You got to see when it's refinancing. I don't want to play here. This is a garbage. Let me see. Mid-single digit compounder. I mean, it's mediocre. It's a trade, so it's $8. Maybe you get a triple if everything goes perfectly, but there are better things to do, in my opinion. Probably okay, but I don't trade it. Yeah. Anyway, options leverage ETF. Okay, we covered that. Ronan bid on from Israel. Again, first want to thank you for the content. Always look forward. Would be happy if you could refer to the Baxter report. So Baxter actually reported decent earnings. This is a turnaround story. We own the stock. We like the stock. You're going to get a massive resurgence in elective procedures. And this is what it looks like. So you get a lot of restructuring, you get a lot of hairy earnings, but the revenues increased at 3% and 4% on a constant currency basis. So it's going in the right direction. They came in better than expected. So you're just going to get some bumpiness and uncertainty about the continuing operations, discontinued, the tax-free spins. It'll just be hairy until it's not, like 3M, and then it'll be great again. But this is a business with many, many decades of compounding capital at high rates of returns, and then drawdowns in periods of recession, rinse, repeat over and over and over. You had 80, 85, 92 recession, 2001 recession, 2009 recession, and the COVID recession. Every single time it recovers and works its way to new highs. This time will be no different. So you'll get a few hairy quarters, we'll stick it through, and we'll get our double or triple, and we'll be off to the next. So nothing changed there, Ronan. Don't get caught up in the short-term noise. With that said, I want to thank everyone for tuning in. It's been a great week. Very grateful for everyone. For those of you who got in on this round, we're already putting capital to work. For those of you who we've spoken to that are going to be sending in your subscription agreements in coming days, we'll be opening. You'll be able to fund within 6 or 8 weeks, and we'll put your money to work right away as well. Very grateful for that. And again, I want to emphasize the people who've been with me from the beginning. You're awesome, and everyone that's just consistently tuned in and supported the podcast. Very exciting, just getting started. We'll see you next week, same time, same place. In the meantime, make it a great one. Bye for now.